Hello everyone, my name is Murtaza Qaid and today we are going to start a new chapter, that is financial instruments. My friends, this is one of the most important, most detailed and honestly one of the complex area in the entire world of financial reporting. If you go and ask any CA or ACC student, any professional accountant or any financial reporting expert that which area gives you the most difficult time, I guarantee most of them will point to financial instrument. And the reason is simple. This is not just one standard. It is a whole family of standard. It has layers of rules, complex measurement models, tricky classifications, decisions and concepts that are completely different from traditional accounting. And that is exactly why we are here, to break down this area step by step, concept by concept, so that by the time we finish this chapter, we will understand it thoroughly and confidently. So pay very close attention from the first lecture. Everything we discussed in these early lectures will be the foundation for everything that comes later. So are we ready? Let's begin. My friends, let's start by understanding why do we even have a separate set of standards for financial instruments? Why could not traditional accounting handle all this? In the old days, around 60-70 years ago, business was relatively simple. Companies sold goods, collected cash, paid suppliers, borrowed from banks, and their financial instruments were basic things: trade receivable, trade payable, bank loans. So traditional accounting handled all of this just fine. For example, you borrow $1 million from a bank, so you record a liability of $1 million. You sell goods on credit, you record a receivable. Simple. But then, my friends, the financial world started to evolve, and it evolved very, very rapidly. Companies started entering into the forward contracts to manage their foreign exchange risk. Entities started investing in highly complex financial securities. Banks started creating complicated products, bonds with special features, convertible notes, preference shares with unusual terms, all kind of derivatives. And here is the problem. Traditional accounting was simply not equipped to deal with all of this. And this is why the IASB, that is the International Accounting Standard Board, developed a dedicated family of standards specifically to deal with financial instruments. So remember this context, my friends. These standards exist because traditional accounting was simply inadequate for the complexity of modern financial transactions. Now, at this level, this chapter is very comprehensive. We will be covering number of lectures on this area, and that alone tells us how important and how detailed this area is. So right from today, I want you to be fully focused and engaged. Alright, my friends. Now let's talk about the standards that make up this chapter. This is the very first thing you need to understand: the landscape of standards. My friends, when we talk about financial instruments in IFRS, we are not talking about just one standard. We are talking about multiple standards that work together. And let me introduce each one to you. The first standard is IAS 32 Financial Instruments Presentation. My friends, IAS 32 is the standard that deals with the classification and presentation. IAS 32 defines what a financial instrument is, what a financial asset is, what a financial liability is, and what an equity instrument is. And most importantly, IAS 32 tells you when do you have a financial instrument in your hand, how do you classify it, is it a financial asset, financial liability, or equity. This classification is absolutely critical because it determines how you present the instrument in your financial statement and ultimately how you account for it. IAS 32 also covers important topics like compound financial instrument, treasury shares, and offsetting, and we will cover all of these in our upcoming lectures. Then the second standard is IFRS 9 financial instruments. And my friends, this is the big one. This is the heavyweight of the family. IFRS 9 tells you how to account for a financial asset or financial liability once IAS 32 has helped you classify it. IFRS 9 covers the entire life cycle of a financial instrument, from its recognition to derecognition. Areas like initial recognition of financial asset and financial liabilities, that is, when do you first record them in your books. It covers initial measurement, that is, at what value you record them on day one. It covers subsequent measurement, how do you measure them at every reporting date going forward. It covers the classification models, into which category does your financial instrument fall. It also covers other important areas like impairment of financial asset, modification, reclassification, and also hedge accounting. And it covers derecognition, that is, when do you remove a financial instrument from your books. In one line, IFRS 9 answers the question, how do you recognize, measure, and account for the financial instrument. The third standard is IFRS 7 financial instrument disclosure. As the name says, IFRS 7 deals with disclosures. Even if you have recognized and measured your financial instrument perfectly under IAS 32 and IFRS 9, the story is still not finished. Users of the financial statements also need to understand what type of financial instruments does the company hold, what are the associated risks, credit risk, liquidity risk, market risk, how is the management controlling those risks, what is the impact of financial instrument on the entity's financial performance and financial position. So IFRS 7 requires all of this information to be disclosed so that investors, lenders, and other stakeholders get a complete and transparent picture. In one line, IFRS 7 answers the question, what do you tell the world about financial instrument? And the fourth standard is IFRS 13, fair value measurement. Now my friends, IFRS 13 is not exclusively a financial instrument standard. It is general standard that applies across all the IAS and IFRS where fair value measurement is required. But as you will see when we go through IFRS 9, many financial instruments are measured at fair value. So IFRS 13 becomes very relevant for us. It provides the complete framework for how to determine the fair value, what inputs to use, what hierarchy to follow, and what to disclose about fair value measurements. Again, in one line, IFRS 13 answers the question, how exactly do you determine the fair value of financial instrument? So my friends, all four of these standards complement one another, and you need to apply all of them together to properly account for your financial instrument. Are we clear on that? Good. Now let's move on. Okay, now this is where we start the actual technical content, and we begin with the most fundamental question: what is a financial instrument? My friends, IAS 32 gives us this definition. A financial instrument is a contract that gives rise to both a financial asset of one entity and financial liability or equity instrument of another entity. Let me repeat. A financial instrument is any contract that gives rise to both a financial asset of one entity and financial liability or equity instrument of another entity. My friends, this definition is telling us two things. First, financial instrument is a contract, that is, it arises from a contractual arrangement between two parties. And second, A financial instrument always involves two parties. On one side, one entity records a financial asset, and on the other side, the other entity records either a financial liability or an equity instrument. So there is one contract, two entities. One record an asset and the other record a liability or equity. That is a financial instrument. Now my friends, I'm not going to go into the detailed technical definition of financial asset, financial liability and equity instrument today. We have separate dedicated lectures coming up for that. But what I do want you to understand right now is the concept with good practical examples. So let me walk you through several examples, and I want you to notice one thing every single time. One entity records a financial asset and the other entity records either a financial liability or equity. First example is of credit sales, and this is the most everyday example in accounting. Let's say Company A sell goods to Company B on credit. In this case, Company A would record trade receivable on the debit side, that is financial asset, and revenue on the credit side. And Company B would record purchases or inventory on the debit side and trade payable on the credit side, that is the financial liability. So do you see it? Company A has the financial asset, that is the trade receivable, and Company B has a financial liability, that is the trade payable. And the credit sale between them is a financial instrument. My friends, we have been recording this entry since the very first day of our accounting education, but we never called it a financial instrument. Now you know it is one of them. Then the second example is of ordinary shares issued by a company. Let's say Company A goes to the stock exchange and buys newly issued ordinary shares in Company B. Now in this case, Company A would record investment in shares on the debit, that is financial asset, or more specifically equity investment, and cash in bank on the credit. And Company B would debit cash in bank and credit share capital, that is equity instrument. So Company A has a financial asset and Company B has equity. Again, one contract, two sides. Then the third example is of a bank loan. Let's say Company A takes a loan from a bank. Here Company A would record cash on the debit and bank borrowings on the credit. This bank borrowing is a financial liability. And the bank would record loan to customers or loan receivable on the debit side, that is financial asset, more specifically debt investment, and cash or bank on the credit side. So Company A has financial liability and bank has financial asset. Then the next example is of debentures or bonds or any other debt instrument. Let's say Company A issues debentures to raise money from the investors. Here Company A would debit the cash in bank and credit the debentures payable, that is the financial liability. On the other hand, investors would debit investment in debentures, that is financial asset, and more specifically debt investment, and credit the cash in bank. So Company A has a financial liability and the investor have a financial asset. Now my friends, the next example of preference share is very interesting because it depends on the type of preference shares, and this is where an important principle of substance over form comes into play. We already know that preference shares can be either redeemable or irredeemable. Now let's say Company A issues redeemable preference shares, meaning there is a fixed maturity date and company must repay the money after, let's say, 5 years or 10 years. So in substance, this is a liability. The company has contractual obligation to repay. So from Company A perspective, redeemable preference shares is financial liability. And from investor perspective, investment in redeemable preference share is financial asset, specifically a debt investment. But if Company A had issued irredeemable preference share, meaning the company will never repay this money unless it winds up and liquidates. Then in substance, this is equity. There is no contractual obligation to repay. So from company A's perspective, irredeemable preference shares is equity. And from the investor's perspective, investment in irredeemable preference share is financial asset, specifically an equity investment. My friends, legally, both type of preference shares may look like shares. In many country companies law, both can be called shares. But when we prepare financial statement under IAS and IFRS, we look at the substance of the transaction, not the legal form. The substance of redeemable preference share is that of liability. You must pay it back. So we treat it as liability. And the substance of irredeemable preference share is that of permanent capital. So we treat it as equity. And this has very important consequences. The dividend on redeemable preference share is treated as finance cost, interest expense in profit and loss, because the instrument itself is a liability. So the cost of that liability, the dividend, is financing cost, just like interest on a bank loan. But the dividend on ordinary shares or irredeemable preference shares is a distribution to equity holder. So it goes in the statement of changes in equity, not in the profit and loss. This is one of the most commonly tested point in exams, my friends. Where does the dividend go? And the answer is, it depends on whether the instrument is classified as a liability or equity. So are we clear on that? Great. Now my friends, before we move on, let me also quickly tell you what is not a financial instrument. Number one, physical assets. For example, property, plant and equipment, inventory. The reason is these are physical items. You use them to produce goods or generate service. You don't receive cash or another financial asset from the item itself. Number two, prepayments. For example, if you pay rent in advance, the landlord will give you the right to use the property in return. That is goods and services, not cash. So a prepayment is not a financial instrument. Number three, deferred income, or what we call contract liabilities. If you receive advance payment from a customer, your obligation is to deliver goods and services to them, not cash. So again, this is not a financial instrument. Number four, income tax liabilities and deferred taxes. These arises from the statutory requirement under tax laws, not from a contract between two parties. So income tax and deferred tax are not financial instrument. My friends, the key test is a financial instrument must involve a contractual right to receive or a contractual obligation to deliver cash or another financial asset. If it involves goods, services or a statutory obligation, it is not a financial instrument. Are we clear on that? Great. Alright, now let's talk about when you first recognize a financial instrument in your books. This is called initial recognition, and the rule is very straightforward. IAS 32 and IFRS 9 says an entity shall recognize a financial asset or a financial liability in the statement of financial position when and only when the entity becomes a party to the contractual provisions of the financial instrument. Let me translate that into simple words. You record a financial instrument in your books. On the date, you become party to the contract. Not when you pay the cash, not when the goods arrive, but when you sign the contract and legally become bound by its terms. My friends, this is different from how we think about physical asset transaction, where we typically recognize when risk and reward transfers or when we gain control. For financial instrument, it is purely contractual. The date you become party to the contract. So the key message is, you recognize a financial instrument when you become party to the contract, That is the trigger. Are we clear on that? Perfect. Alright, my friends. Now we come to what I think is the most important topic of our today's discussion, the classification models. This is the big picture framework of IFRS 9, and you must understand this before anything else in this chapter. So listen to me carefully. Once you have recognized a financial instrument in your books, the next question is, in which category does it belong? And why does this matter? It matters because the category determines how you measure the instruments subsequently. Different categories have completely different measurement rules. So getting the classification right is absolutely fundamental. Everything flows from this. Let me walk you through this systematically. First, remember, a financial instrument is a financial asset for one party and a financial liability or equity for the other party. When we talk about classification, we are dealing with two things: classification of financial assets and classification of financial liabilities. For equity, there is no classification to worry about. Equity is equity, full stop. Let me now take each one separately. My friends, financial assets come in two broad types. Remember this because it is important. Number one is equity investment. These are investments in the shares of another company. And number two is debt investments. These are everything else that is not an equity investment. Things like trade receivable, loan given, investment in bonds, debentures, or similar instrument. Now, IFRS 9 gives us different classification options for each type. For equity investments, IFRS 9 gives us two classification options. Number one is fair value through profit and loss. This is the default classification. And number two is fair value through other comprehensive income. This is available only if certain conditions are met and if the entity makes an irrevocable election. In both cases, equity investments are measured at fair value. The difference is only where the fair value gains and losses go, either through profit and loss or through other comprehensive income. We will cover the details of this election in our later lectures. For today, just remember, equity investments has two options: fair value through profit and loss or fair value through other comprehensive income. Then for debt investment, IFRS 9 gives us three classification options. Number one is amortized cost. Number two is fair value through other comprehensive income. And number three is fair value through profit and loss. Now, how you decide which option applies? That depends on two tests. First, the entity's business model test. That is how the entity manages the financial asset. And second, the cash flow characteristics of the instrument, specifically whether the contractual cash flows are solely payment of principal and interest. We call this the SPPI test. My friends, the business model test and the SPPI test are the foundation of the classification of debt investment under IFRS 9. And we will dedicate entire lecture to these two tests, so don't worry about the details just yet. For today, just appreciate that for debt investment there are three possible classifications: amortized cost, fair value through other comprehensive income, or fair value through profit and loss. Alright, now look at the financial liabilities. The classification options here are simpler than for financial asset. IFRS 9 gives us two options. Number one is amortized cost. This is the default and it applies to the most ordinary financial liabilities. Things like bank loans, debentures issued, and trade payable. And number two, fair value through profit and loss. This is less common and is used in specific circumstances. For example, when an entity designates a financial liability at fair value to eliminate or reduce an accounting mismatch. My friends, let me now pull all of this together in one summary. I want you to memorize this framework because everything in this chapter connects back to it. Financial instrument divided into financial asset, financial liability or equity. If it is a financial asset and it is an equity investment, classification is either at fair value through profit and loss or fair value through other comprehensive income. If it is a financial asset and it is a debt investment, classification is either amortized cost, fair value through other comprehensive income or fair value through profit and loss. If it is a financial liability, classification is either at amortized cost or fair value through profit and loss. If it is equity, no classification is required. Equity is equity. Simple. My friends, look at this framework and memorize it because all the measurement rules, impairment rules and derecognition rules we will cover in our later lectures, all of it connect back to this classification framework. If you understand this today, the rest of the chapter will follow much more naturally for you. Now, I want to be very clear. Today, we have only introduced these classification models at a high level. We have not yet covered how to determine which classification applies in detail. The business model test, the SPPI test, all of that is coming in our upcoming lectures. We have not yet gone into the detailed definition of financial asset, financial liability and equity, or the most important topic of how to distinguish between a liability and equity in complex situation. Each of these topics has its own dedicated lecture. Today's purpose was simply to give you the full overview, the landscape, so that as we go deeper, you always know where you are and how everything fits together. Alright my friends, in today's lecture, we have laid the foundation for this entire chapter on financial instrument. We understood why traditional accounting was inadequate for the complexity of modern financial transaction and why ISB developed a dedicated family of standards. Then we were introduced to 4 standards: IS 32 for presentation and classification, IFRS 9 for recognition and measurement, IFRS 7 for disclosure, and IFRS 13 for fair value measurement. We covered the definition of financial instrument and worked through some practical examples with journal entries from both parties. We applied the principle of substance over form and understood the consequence for dividend treatment. We also clarified what is not a financial instrument. We covered initial recognition, that is when you recognize a financial instrument when you become party to the contractual provisions. And we covered the classification models, the big picture framework of IFRS 9 that everything else in this chapter is built upon. In our next lectures, we will start going deeper. So I hope I have been able to explain these concepts clearly to you. This was overview lecture, our map of the territory. Now in the lectures ahead, we will explore each part of that map in detail. Let's conclude today's discussion here. Thank you for watching.